Yeah, it's a great point. Dow Industrial's down 115 right now. Joining us right now to break it all down, Fundstrat Global Advisors Managing Director and Global Head of Technical Strategy, Mark Newton, Georgia Congressman and House Budget Committee member Earl Buddy Carter, former IMF Chief Economist and Harvard University Economics Professor Ken Rogoff, also, of course, Cheryl Casoni. Great to see everybody. Thank you so much for being here. Ken Rogoff, kick us off here. Assess the Producer Price Index that you're seeing this morning and the level of inflation overall. Is this what you expected?
Well, it's not exactly what I expected. I thought we'd see a little bump up in the producer price index. But I think overall, it's pretty clear that goods prices, which went way up, are coming down. But that's only 25% of the economy, 75% of services. And we're seeing much more entrenched inflation there.
Yeah, that's a great point, because when we were in the middle of COVID, people were buying things from their home and then they stopped and wanted to get out, take vacations, go out, services. And of course, it is 75% of our economy. So that's having a bigger impact. Do you see inflation coming down in the services part of the economy, or is it still elevated, Ken? Because shelter is still an issue, right?
Well, I think it's coming down. I think that last mile of getting inflation down to 2% is not going to be so easy. I'm not sure that the whole next decade is going to be so easy for the Fed compared to the last one. But I'm in the camp where it's more likely a soft landing than a deep recession if they bring interest rates down, say, 1% over the next year.
Let's talk about the macro story and what you're seeing from technical strategy. Mark Newton, jump in here. How would you assess the trading so far of this market year to date? What does 2024 look like, and how do you think it plays out based on what we've seen so far in the first week and a half?
Yeah, thank you, Maria. So there has been a little bit of a New Year's hangover after the extraordinary run that we saw from last October up into end of year. Remember last year, it was largely just technology that participated up until October, and then we saw a real broadening out. And so I think overall that's going to be helpful for this year, the driving markets higher. My target's 51.75. In the short run, though, I do have some concern about consolidation in the first quarter. Seasonally speaking, it tends to be, one of the worst periods in the election year is the first quarter. We do tend to be choppy. Sentiment has risen pretty sharply in recent months. And, you're seeing a little bit of a, waning in breadth in the market in general. So, we went from one of the almost the fastest on record from being the percentage of stocks below their 50-day moving average being down under 15% to over 90%. So a huge move in a short period of time. My thinking is we're going to consolidate really over the next couple months where we could drop 6 to 8%. I don't think it's going to be all that dramatic, but I think in general it is going to provide buying opportunities come spring for investors.
Yeah, I mean, you write in your most recent note, weakness over the next week looks possible and could kick off a larger decline, which extends into March. Mark, going into March, of course, the word is that we could get a rate cut, either March or May. Where are you on that possibility?
Well, I think the market's gotten a little too aggressive about building in all these rate cuts, and the economy has actually held up a little bit more resiliently. So I think there's a little bit of a disconnect, and we've seen rates start to tick higher a little bit. The most important thing for investors to concentrate on is the direction of the U.S. dollar and also Treasury yields. We moved down over 100 basis points very quickly in yields. Now we're seeing a bounce not only in yields but also in the dollar. I think that is important. That is likely what coincides with a market decline over the next couple months. But the bigger picture is that I think inflation likely is going to continue to fall, into the summer. And I think in general that yields could honestly drop down to near 3.25%, which is a big, big move in a short period of time. So, any recession should be put off at least until 2025. And I do think it's coming. It's just going to be postponed. But, this should be actually an easier year for investors than last year, based on this broad-based recovery that we saw last October. So we saw healthcare, financials, all these had huge moves off the lows. Now I suspect we're going to see consolidation in most of these groups. But in general, that should provide buying opportunities in the months ahead.
Well, I mean, let's look at where policy fits in here, Congressman Carter, because the reason we are even at this point trying to look at inflation come off of the highs of the last year and a half is because of all of the spending. happening and the $6 trillion in borrowing that took place on Joe Biden and the Democrats' watch. You're right now in the middle of a battle with your colleagues to try to keep a cap on spending. Can you tell us where you are on that?
Well, Maria, there's a lot playing into this, as you can well imagine. We got the border situation that plays into this, but we've got to cut spending. There's no question about it. You know, all told, when you figure in revenues and everything, the federal government spends over $6.4 trillion a year. That comes out to be $204,000 per second. The speed of light is 186,000 miles per second. We're spending money faster than the speed of light. This has got to stop, and this is what has got us in trouble. Let's don't lose sight of the fact that inflation was at 1.4% when Joe Biden took office. Then we can make all the arguments about, oh, it's coming down. But until inflation is negative, prices are still high. And when I'm in the district, that's what people are talking about, how high prices are.
So are you willing to take it to the mat to say, I'm not agreeing, my vote is a no on this spending package unless you actually see change at the border? And does that mean we'll see a government shutdown after January 19th?
Look, I would rather see the border shut down than to see the government shut down. There's no question about that. But we have got to have relief at that border. When I'm in the district, people are asking me all the time, what do you do? What's going on down there? Why aren't we securing that border? How can you justify sending money to other countries to secure their border when our border's not secure? And you know what? They've got a point there. That we shouldn't be doing that. We've got to secure that border. The number of illegal immigrants that are coming, that are utilizing our services, that we're having to provide services to, the amount of fentanyl killing our citizens, all of this is just out of control. Number one issue for people in the district is the border and securing the border.
Of course. And Cheryl, I want you to walk us through what we've learned today on inflation, because I spoke with Jamie Dimon this week on the macro story, and he went right to all the spending when I asked him about the macro story. And I want to play this soundbite for you, because all I asked him was, are you in agreement that we're going to see 3 rate cuts? Listen to this. Where does the Fed fit in, Jamie? Right now, it's pretty much priced in. We're going to get 3 rate cuts this year, possibly 2 or 3 rate cuts in 2025. Do you agree with that?
I'm a skeptic. I think that because of fiscal spending and other factors, and let me list them for you for a second. I look at a lot of things, and forget just economic models for a second. $2 trillion of fiscal deficit, the Infrastructure and IRA Act, the green economy, the remilitarization of the world, the restructuring of trade are all inflationary. And that looks a little bit more like the 1970s to me. So I think there's a chance that people should be prepared for that inflation comes down, but then bounce around 3, maybe even bounced up a little bit, and those implied curves will change.
Bounces up a little bit, Cheryl. That's what we saw from the CPI yesterday.
Exactly. And, again, this morning, once the conference call got underway for J.P. Morgan, Jamie Dimon, as well as the CFO, reiterated exactly what he said to you in that interview, that they're talking about inflation. They do see it heading a little bit higher because of all the government spending and the fiscal stimulus they're seeing out there. And, we also saw that last Friday when we got the jobs report out, Maria, because that was, where did you see jobs being created? Government. Health care, social services. And by the way, one of your guests mentioned about the services inflation. There's a little bit of that in today's report on the PPI. If you could just let me hit that for just 2 seconds, because what they were saying was there was price rises for securities brokerage, dealing, and investment advice jumped 3.3%. So, hey, at least we're seeing some profits being made for Wall Street and advisors that are out there. But again, some of that services inflation is still there, but we saw it more with the CPI obviously yesterday than we did with the PPI today.
Ken Rogoff, do you expect that the Fed will in fact cut 3 times this year?
Yeah, I think that's a decent guess. I think the big question's how far do they have to bring it down once inflation stabilizes? And I think there's a very strong case to be made that interest rates adjusted for inflation are going to be quite a bit higher over the next decade than we saw, say, from 2012 to 2021. And Jamie Dimon listed a whole bunch of reasons I could repeat, but certainly the high level of debt, which the congressman emphasized, populism, defense spending, green transition, and all these things I think are pushing up the normal interest rates. Look at this another way. Interest rates went really high, and we didn't have a recession. And okay, maybe a soft landing is going to lead to a recession, but maybe also the economy just is adjusting to a higher level of interest rates than we've been used to.
Yeah. And this conversation is the conversation taking place this morning on all of the conference calls underway for the major banks. I want to get Anton Schutz's take on this because the big banks reported a mixed bag this morning for the fourth quarter results. Citigroup reported mixed results, posting a $1.8 billion loss. JP Morgan reported a double beat, despite paying a $2.9 billion fee tied to the government seizures of failed regional banks last March. Joining me right now is Menden Capital Advisors President and Chief Investment Officer and RMB Menden Financial Services Fund Portfolio Manager Anton Schutz. Anton, you have been a bank investor for, what, decades, right? How would you assess these bank earnings today? Can you walk us through what strikes you most?
Well, I mean, first of all, no disaster, right? If you go back to last spring, everybody's predicting doom, gloom, disaster. As recently as October, you saw these stocks way, way down. Now, you saw a giant rally. You've seen these stocks move a lot. You've seen a lot of short covering because disaster hasn't been here. And again, today is not disaster. Today is not reflective of the giant move we've seen in the stocks. However, they're still traded, 10, 11 times earnings and not a giant premium to book value. We still don't know many things, right? We don't know the Federal Reserve, how many times they're going to cut. We don't know how much capital the banks are going to have to carry. People are still afraid of commercial real estate. We keep seeing it. Even the regulators have talked about it. But these banks have de minimis exposure as a percentage of the total bank. So at the end of the day, these numbers, if you kind of take the whole group, are sort of good enough, right? The whole group is, you even it out and you're kind of flattish. Now, everybody's assumptions for forward guidance is different. How many Fed cuts do we have? Do we have 4, 6, 2, 0? Do we have increases? So all of their assumptions, you've got to parse through them. And clearly, some of them have also become, very popular lately. Citigroup has become very popular. People look at it and finally say, oh my gosh, look at the discount to book value. Jane Fraser is doing a lot of things. Let's buy this. Let's not focus on earnings. Let's focus on what the long-term structure is here. JP Morgan, again, as they continuously do, beats, raises, executes. But if you also look at the technical on JP Morgan, and by the way, we have no position in it, it looks very overbought. And that doesn't mean it can't go higher. It just means from a technical level, some of these things actually look overbought. Bank of America being down is logical if you expect Fed cuts. And by the way, we do own that, full disclosure. It's still cheap. I still expect them to generate a lot of great earnings. And again, the other thing that's important here is credit quality continues to be fine. Right? I mean, there's minor tweaks here and there. Obviously, the subprime consumer is hurting a bit as they run out of savings. But, the bank earnings are good enough. And if you go into the smaller banks, which is where I love to focus, they're much, much cheaper, right, on a PE basis, on a price-to-book basis. But the money's always going to flow to the big first because that's where the liquidity is. If I'm a big mutual fund, I have to buy bank exposure. I'm buying Citibank. I'm buying JP Morgan. Yeah,
it's a great point. But, when you say the earnings are good enough to warrant this huge move in the stocks, right? I mean, when you look back to the end of October, when it was clear that the Fed signaled they were done raising interest rates, that's when you saw this shift. Okay, all of a sudden the bank stocks come out of their funk that they were in all year, and they start buying up these stocks, but all along that funk, JP Morgan was sort of the safe harbor, the safe place in a storm. So I want to know from you now, going forward, that we have this idea that the Fed is done raising interest rates. Do you want to buy some of the small or mid-cap names? I've been waiting for a bid on some of these small caps because it felt like this market wants to broaden out. Is that what you're expecting?
Yes, we do expect a new focus on the smaller names. Lots of bank conferences coming up over the next few months post earnings. Again, everybody's going to parse the earnings and go, okay, are they good enough? M&A is very clearly on the minds of every small bank. They're all talking to each other. They all want to figure out how they can get bigger so they can deal with new regulatory issues. They want to figure out how to get bigger so they can spend more money on technology and spread that out over a larger base. But M&A is going to be a very, very big theme. One of the reasons M&A got held up so much were the terrible marks on their bond portfolios. Well, the bond market has rallied a great deal. The marks have really abated quite a bit. And now people are looking through those marks and going, okay, the math on M&A actually works.
Yeah.
We would like to see the regulators approve some deals that are out there. I mean, we're in an environment right now where the regulators are just not commenting or not allowing deals to close. But this is an industry that needs to keep consolidating, right? We don't need 5,000 banks.
So real quick, how would you assess the bank earnings that have come out this morning? What would your characterization be?
As expected, mixed, because some good, some bad, but nothing that you would point at and go, this is terrible, or nothing you would point at and go, this is amazing. Right?
Well,
JP Morgan
let me
beat.
just
They
say
always
this.
beat.
You say there are green shoots and we're going to see capital markets activity come back. Maybe M&A picks up in 2024. And I say to you, not if the FTC has anything to do with it, okay? Because the government right now, as you know, is becoming really heavy-handed when it comes to lots of deal flow. Am I wrong?
No, you're spot on. And, if you look at what the bank stocks did when Trump first won, it was one of the best months in the history of the banking industry because the stocks just went straight up. Everybody said, okay, regulation, is going to be better. M&A is going to happen. Deals are going to get approved. So
that's right.
Yeah, I mean, it is a political statement, but, at the end of the day, you do need a lot of commerce to happen. You do need to have consolidation happen. And I've given you all the good reasons as to why to let it happen. These small banks are, hot dogs and apple pie and, they are small town America. You need to let these companies thrive and compete. If they're competing against JP Morgan, how are they going to do that without spreading out the costs?
Well, and how they're going to do that when you've got regulations that are in some cases are just a brushstroke. Everybody gets painted with the same regulations, whether you're a huge mega, G-SIB bank or a small bank. That's a problem. Anton, thank you. Great to see you. Anton Schutz, assessing the bank earnings. I'm back with my panel right now. And Buddy Carter, I want to take that question to you in terms of this heavy-handedness of the government stopping deals. You've seen a number of deals get paused, stopped because of the FTC saying, no, that's anti-monopolistic. Your thoughts?
No, there's no question about it. And it is all throughout government. I serve on the Energy and Commerce Committee as well as the Budget Committee. And when I'm visiting Houston, I went 3 times last year to Houston. The number one thing they're talking about is overregulation. The permitting process. It is all throughout. It's systemic in our government, and it is crushing business. And the same thing in the economy. It's just crushing us. That's why we've got to have oversight over these agencies and stop some of this that's going on. That's why we got to have a change in policy. That's why we got to have a change in administration in November.
Yeah, I'll never forget when Trump made a big deal about him cutting regulations. He made it a big event with big scissors and red tape, and he said, cutting regulation is a beautiful thing, Mark Newton. So I want to know from you, do you feel that the fundamentals that we're talking about of being an election year change anything about the technicals that you're looking at with regard to this market?
No, I don't think that's the case. Honestly, look, we understand all the problems, but if anything, that creates a wall of worry, and markets typically are able to rally through that. If anything, this being an election year makes it that much more contentious. We also have 2 wars going on. We have $6 trillion in cash on the sidelines. Companies, in general, are really loath to put money to work when there's such a poor social mood out there in the country. And so, I think that it actually creates a decent environment for stocks for the next year. But if you look at history, during election years, markets usually rally from the spring, April, May, up into August. Then we consolidate into the election, and then you have the big boom. So I think once this is past us in November, that's really when investors become more confident because all this indecision will be past us, and that's honestly a better environment. Probably November into next spring, summer of 2025.
So, Mark, if I wanted to trade this market, which I don't recommend for most people, I think you want to be a long-term player and not trade. However, your scenario that you're putting forth is that we could see some rockiness in the markets until March, but then you want to buy sell-offs, you want to hold stocks March through the election or March to November before the election. Yes,
that's 100% correct. And I think if investors have a 12-month time frame, RSP, the Invesco's equal weighted S&P ETF, makes a lot more sense than SPY or QQQ. To your point earlier, small caps are now in a window where they should show some decent outperformance this year, and that's going to come as rates continue to drop in the months to come. So, I think a well-balanced, diversified portfolio, and honestly, as the dollar starts to roll over, likely in the months ahead, that's going to provide fuel for emerging markets as well. And so one would want to necessarily look outside the U.S. for opportunity there.
Yeah, small caps and emerging. Good point. Ken Rogoff, I want to get your take on the rest of the world, because it's not just the U.S. that is weakening. There are many out there who feel that it's the ECB that is going to cut rates before the Federal Reserve cuts rates this year. How do you compare Europe to the U.S. right now in terms of the fundamental backdrop, Ken?
Well, Europe's in much more trouble than the U.S. Germany was virtually in recession, might be again. The U.S. is doing well compared to everybody else. I want to make one point about the election. It's not just who wins, but do they win big? Because I think, obviously, if you get the Democrats controlling the Senate and the House and the presidency, you know what's going to happen to the debt. Right. But I bet the same would happen if the Republicans get in power, although they'll cut taxes instead of just raising spending. So if you're looking at how inflationary is the environment going to be, it's not just who wins, but, is it big or is it a split government?
I think this is a great point that you make, Ken. And right now, we're looking at a fight underway because there's such a small majority for Republicans, because the Senate will mark down things that the Republicans push forward. Do we expect that it is going to be an outsized move toward the end of the year? What do you think happens, Ken?
Well, it's the biggest wild card in the whole global economy. But, again, you asked about the global economy. China's growth is very slow. So the rest of the United States had a soft landing. The rest of the world's been a lot bumpier.
Buddy Carter, weigh in on this and this idea that you only have a two-seat majority in the House. Do you believe you have an opportunity, the Republicans do, to take the Senate in November?
No, there's no question about that. We're very confident in our chances of taking the Senate, and I think we will. I hope and I expect that we will maintain the majority in the House. I hope we can grow the majority in the House. And, of course, if we can get control of the White House and have control again, and I know there are those who argue, well, you had it before and you weren't able to deliver well. We're convinced because, Maria, elections are about policy. And it's policy that makes the difference. We're right on policy. We are right on the economic policy. You talk to people in the district, in my district, and they'll tell you, they're being crushed right now. They're spending $950 a month more on the basics, just rent and groceries, than they were before Joe Biden took office. Yeah. And they need relief, and they want relief.
Yeah, I think my favorite line, Cheryl, from my Jamie Dimon interview was when he said, my heart is Democrat, but my head is Republican, because we need good policy that works.
Yeah. Fiscal policy and fiscal responsibility. Many Americans struggle and work to balance their checkbooks, but, many voters are going to ask, is the checkbook balancing in Washington? And there's been so many ill effects to the fiscal spending that we've seen under President Joe Biden. And the point was made earlier, it's good to reiterate that consumer inflation has, jumped by double digits. And look, remember, too, because we'll sit there and say, oh, well, CPI, it's, 2.8% or 1.5% or whatever it is year over year, but it's still gaining ground every year, and it's been gaining ground since he took office. But those are, that's why CPI was such a big report this week, and it was so important for us to all go through it like we did yesterday, because that is the kitchen table, and that is how people are going to vote. The famous line, "It's the economy, stupid," is coming right back to roost again in 2024. It's going to be real interesting to see how people, what they do. And look, the Iowa caucuses are Monday, Maria. I mean, here we go. We're kicking it off. Whether or no weather, we have Iowa on Monday.
Yeah, we got Iowa Monday. Buddy Carter, weigh in here, because this week for some has felt like a month. Congress attempting to prevent a partial government shutdown, which could happen next Friday, the 19th, then a full shutdown on February 2nd. A little bit of a Groundhog's Day going on. Will you vote yes for this continuing resolution that apparently appears to be required to avoid this shutdown?
Well, I think we're not going to have any other choice. In order to avoid a shutdown, we're going to have another short-term continuing resolution. The Speaker has said that he is not in favor of that. He does not want to have that anymore. However, we don't see any way out. We can't get this done next week. And let's deal in reality here. Geez, it'll take us a month to get it done. You want us to get it done in a week? That's ridiculous.
Well, next week, in addition to the Iowa caucus, you've got a U.S. delegation to Taiwan, potential partial government shutdown, because some of your colleagues are saying, you know what? It's okay. I want the government to shut down because I'm not getting any movement on the border. So are you not in that camp?
No. We have got to have changes to that border. Not only have we got to have more money going to the border, we've got to have policy changes in that border. And we've got to enforce the laws that are in effect now. That's what's got to happen with that border. Now, if we don't get changes to the border, then we're not going to have a budget. I will tell you that. And we could be looking at a shutdown.
All right, we will leave it there. Great conversation, everybody. We so appreciate your time. Mark Newton, Congressman Buddy Carter, Ken Rogoff, and Cheryl Casoni. Join me